Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your January 2020 market update. Well, I ended last month's call saying that we could really use a pause in the market rally because the market was looking overextended. And as shown in the yellow shaded area of this chart, the S&P 500 index, the market rally continued until mid-January and then made an abrupt U-turn to end the month pretty much where it started. Small cap stocks had a similar turn of events, rallying until mid-January, but then ended the month much below where they started. Overall, small cap stocks lost 3.21% on the month. International stocks, which is shown by the gray bar there, lost 2.69%. Commodity markets fell broadly, down 7.36%. Bonds gained almost 2% of the month as interest rates declined once again. So what caused this abrupt U-turn in the markets? Well, much of this is being attributed to the alarming and depressing news concerning the novel coronavirus outbreak, which originated in Wuhan, China. A lot of media outlets are comparing coronavirus to that of SARS, which rocked China in 2003. So I want to go over what the situation is with coronavirus and what the potential impacts are on the market going forward in today's commentary. So the reported fatality rates for the novel coronavirus so far is 3% versus 9% of that of SARS. So it does appear to be less fatal so far. However, it also appears to be significantly more contagious than SARS. According to the World Health Organization figures, in China alone, the number of confirmed cases has been doubling every 2 to 3 days since January 20th, which suggests that we're probably still some ways away from seeing a peak in the outbreak. While the fatality rate is lower than that of SARS, it is affecting more people and may result in a death toll that is higher than that of SARS. On the right-hand side of the slide, you can see the situation report from the World Health Organization as of February 3rd. And as of February 3rd, there were over 17,000 confirmed cases, but there's reason to believe that this number is underreported due to a shortage of test kits in China. Of these cases, almost 2,300 or 13 to 15% of all cases have been listed as severe, and there have been over 360 deaths. And just yesterday, a doctor from the National Institutes of Health stated that he believes that about 25% of those infected actually require some form of intensive care, which is why this is such a difficult situation in China. So while the number of reported deaths is less so than what we experience here in the US in a normal flu season, the disruption to the global economy could be significant depending on how this plays out. So a few things to note here is that Wuhan, the epicenter of the outbreak, has a population of over 11 million people. So to contrast that, New York City has a population of just over 8 million people, and Wuhan is 5 times the size of London. Around 60 international flights to over a dozen countries normally depart the city's airport each week. And while travel restrictions have been put in place, risks of further international spread persist. The World Health Organization has declared this a global health emergency, and the Chinese government has been taking unprecedented drastic measures to stamp out the virus as soon as possible, including closing 17 cities and quarantining about 50 million people. Now, China is much more integrated into the global economy than it was during the 2003 SARS outbreak. So while we can look at past outbreaks to see their impact on the market, we need to remember that times have changed since 2003. We're a much more global economy than we were back then. And China is now much more important to the global economy. China now accounts for about 1/3 of global economic growth. So certainly a slowdown there can have ripple effects across the world. What are we likely to see from this, given what's going on right now in China? Well, long term, it's really difficult to determine the virus's long-term impact, but at the very least, we are likely to see a severe short-term impact on economic activity in China and in peripheral nations, which is why we have seen a pullback in many Asian markets. Near-term business activity and consumption will be significantly impacted as people continue to curtail their movements as preventative measures. Reports show that restaurants, theaters, shopping malls, etc., are empty. Many cities in China that are impacted by this look like ghost towns, and consumption is a meaningful contributor to China's economy. So as people are closed in and not spending money, and many businesses and factories are shut down, this will have a short-term impact on China's economy. Now, factories remain closed until February 10th, but any further extension of factory closures would raise risk related to supply chain disruptions for multinational companies, because China is a significant contributor to the global supply chain. Well, what do I mean by supply chain? Let's just look at a simple example of what a supply chain might look like for a sweater. So in terms of getting a sweater to the market, getting somebody to actually buy a sweater, there's a lot of steps in the process. So first, a farmer shears a sheep, the wool is transported to the wholesaler sells the wool to a factory, wool is transported to the factory converts the wool into sweaters are then transported to shops, and then the retail sells the sweater to consumers. So there are many steps in terms of the production of even a sweater. And because so many factories are closed in China, who are, big inputs to this process and many other business processes, that's going to create some sort of disruption for large companies that rely on China as part of their input process. So the longer the factories stay shut down in China and the longer it takes for this virus to be contained, the more impact we will see on the global economy. So what's our overall outlook here? Well, the severity of the slowdown, again, really depends on how long it takes to contain the virus. If the virus is contained the next few weeks, there are good odds of recovery from short-term weakness. If, on the other hand, the number of cases in economic hubs like Shanghai, Beijing begin to rise rapidly, or if the spread accelerates outside of China, the economic slowdown could be more widespread and longer lasting. And the other difference between this and the outbreak in 2003 is that during the SARS outbreak of 2003, the markets had not had good performance for some time, and so you're coming off of lower valuations. This time, we're coming off of a period of very strong market performance in 2019. So we're starting at a higher level, meaning there's further room to drop. And so because of that, and because of the uncertainty around this, markets do not like uncertainty. We do expect volatility to continue and possibly a further correction to occur as long as the uncertainty persists, and the markets are likely to continue to at least consolidate after a period of strong performance. One thing I want to highlight here is this does highlight the importance of maintaining a diversified portfolio. There's wisdom in putting your assets in a number of different asset classes. If you were to look back at December and even early January, emerging markets, which is what China is included in, China is emerging markets. Emerging markets were one of the best performing asset classes due to the phase one trade deal with China. And that turned on a dime because of this coronavirus outbreak. So this really highlights the importance of maintaining diversification in a portfolio, because you never quite know what could happen and what could cause some sort of a downturn in the market. So we are watching this outbreak very closely, and we'll make changes to the portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions that you may have.